Welcome, everyone. Hello. Welcome to this episode of Akrinos Access. I'm Eric Matei, joined by Evon Mendrin for a conversation on this episode about financial planning for modern ODs. Evon, hello, welcome, and thank you so much for joining us on Akrinos Access.
I appreciate you having me on. This is going to be fun.
Yeah, absolutely. So before we jump into everything, share briefly. I know you come from a financial planning background. You're a CFP. You've got some other designations. So just share briefly about kind of where you're coming from and why we should glean your insights.
Yeah, I've been in a financial advisor role for about 8 years now. Had some experience early on in one of those really big financial companies that most people have heard of that sell all sorts of stuff. So have seen that whole world. Spent 5 years at a really awesome private practice financial planning firm before over the last year, I think, leaving that nice job to start a business of my own and focused entirely on optometrists nationwide.
Absolutely. That's incredible, Evon. And I know as you and I have connected and kind of we're talking about what we're going to be bringing to light here in this episode, realizing that, quite frankly, there's a lot of areas that doctors really need to assess when really building out a robust financial plan. And it's going to vary based on kind of where they are in their career, if they own a practice, where they are in the practice life cycle, and what have you. So we were talking about as far as how we're going to frame this up to touch on all this stuff and hopefully a good 45 minutes. And by the way, those that are tuning in live, please feel free. We're going to keep this interactive. So drop any questions or comments in the chat. Absolutely. But we were talking about the best way we thought about framing this up is we'll talk about kind of managing debt, first part of the conversation, right? And then we'll kind of shift gears into talking about really growing wealth. And I know you've got some really great insights to share. So what do you say we go ahead and jump into it, Evon?
Yeah, and when we think about managing debt, and the first debt that usually comes to mind for ODs is going to be student loans, right? That's they go to college, they take that investment, and the cost for that investment is a pretty substantial amount of student loans, and so there's a lot of decisions just right out of the gate, right out of graduation of what to do with that, and so I first want to talk about like how do you approach tackling student debt? And I want to start with, first of all, like where are we at now when it comes to student loans? Because with federal student loans, currently we're in kind of like a weird limbo state because for the last couple of years, payments and interest on federal student loans have been paused. And those payments are expected to restart the 31st of August this month. And we're supposed to be getting ample notification. We're supposed to be hearing things about confirming that that's going to start, but we've heard nothing, essentially. And in fact, everything I'm hearing about student loans, federal student loans, is that the deferment of payments and interest is actually probably going to be deferred once again, kicked down the road once again. So we haven't heard anything, and we really don't know, and so we're in a weird state where we have to sort of plan for payments to start September 1st, but expect them to not until we hear otherwise. And it's sort of a weird limbo state, and a lot of people are wondering, like, what should we do? Should we refinance? Should we continue what we were doing before? And unfortunately, this uncertainty isn't great for borrowers, but you kind of just have to look at, okay, what is the best long-term decision for you based on what your life is and the student loans that you have. Think about the trade-offs and then make the best decision you can, like knowing there's going to be some uncertainty about whether the delay will continue on indefinitely or whether there's going to be forgiveness or things like that. So there's a lot of uncertainty right now. It's kind of a weird timeline, but you just kind of have to make the best decision with the information you have.
Absolutely. And on that note, also, I know something that's a common question among new grads. They're looking at this mound of debt, but they're also considering about starting to create wealth, starting to put away some retirement funds or have other investments. So, I mean, what if what, if anything, kind of goes into evaluating how you should balance where you're allocating your funds?
Yeah. I mean, it really is a balance. So you need to think about what are the different life and career goals you want to sort of target in the near future. What amount of cash is available? Thinking about, okay, you have your income, your expenses, what's actually left for you to do something with? What type of debts do you have? Do you have long-term fixed debt like a mortgage? Do you have student loans? What type of student loans? Is it credit card debt? So you kind of have to just evaluate what type of debt you have, and then try to make the best balance out of all these different competing goals that you have. And as there's some math that comes to it, because a lot of the times it's should I invest? Should I pay off my debt? Should I put more money towards one thing or my debt? There's always sort of trade-offs and opportunity cost, and there's some math to those decisions. So on the one hand, there's things that are like mathematically optimal. On the other hand, there's things that are like values or emotionally optimal. Some people feel really strongly one way about debt, and they really need to handle it because it's just frustrating or it makes them nervous. And so you kind of have to find the best balance between those things versus your goals, the things you want to do in your life and career, your family needs and cash flow needs, the types of debt you have, and what are the other opportunities. And with student loans, like especially, it's you kind of have to like suspend, you kind of have to suspend traditional debt planning with student debt. Like just
Sure.
put aside traditional debt planning for a moment when you have student loans, because they have a totally separate set of rules, and it's its own ball game. So you kind of have to set that aside when thinking about what are the best options for me and how to tackle that.
That's fascinating. It's fascinating you bring that up, because I suppose that there's two big things that you brought up there that I found really key, I think, to kind of take away. And one has to do with certainly what you just said, right? Like abandoning student loan from any other sort of debt planning, leveraging, what have you. But then also the second thing was to realize that in all of this, and particularly for those earlier in their career who do have that debt, right? There's the math, but there's also just the personal values and the emotion and that personal drive. And that's quite fascinating, right? Because typically when we consider financial planning, we think kind of more just like hard numbers and there's definitive right and wrong. But that's definitely important to recognize that there is the personal valuation that goes into it.
Almost every financial decision is wrapped in emotion, and there's family history and there's values around money and debt and all that. So that has to be taken into account. Because if it's not, you end up doing something that, even if it's mathematically right, you end up frustrated about, and you just it's really frustrating. So you have to take that balance into account.
Yes. One of our live audience said debt management. What is it? Debt management starts in middle school. Debt management starts in middle school. Huh.
Interesting. Yeah.
Interesting. We need to spread that nationwide, because I don't know if it's happening here and if my middle schoolers are being exposed to that. But we teach them well in the home, right? Okay. So on the topic of debt, and again, thank you for kind of giving us a bit of a crash course and understanding of student loans. Certainly the current landscape with all these questions about what's going on with when payments kick in and should we refinance, should we not? Also with how to balance paying those student loans, right? But now let's shift gears while we're on the topic of debt and consider other debts that many optometrists may carry. And whether that is someone that's early in their private practice and still paying off financing from that, or perhaps more in this middle part of their career where perhaps they're purchasing real estate, what have you. So let's talk a little bit about managing debt for the established doctor who's a bit further in their career.
Yeah, managing debt for someone who's a little bit further in their career is to me about what type of debt is it? Is it productive debt? Is it not productive debt? What is the mathematically right answer with either paying down that debt or whatever else you're going to do with it? Because if you have practice debt that's fixed, over a pretty good term, reasonably low interest rate, and you have other opportunities to either reinvest in your practice or outside of the practice, you want to look at what is going to eventually have a better effect or a more positive effect on your net worth over time. So for someone who has more established cash flow, who has debt in their life, whether it's in the practice, outside of the practice, you're evaluating it more from what is going to have a more positive return on your net flow, on your net worth over that time period and over the long term, versus, again, your values, because some people, again, just have a certain way of thinking about debt and finances that have to be taken into account. And you just sort of need to decide what is going to have from a mathematical point of view, better positive impact on your net worth over the time period of the debt and over the long term as well. And a lot of times it comes down to whether it's investing in the practice, but a lot of times it's investing outside of the practice in retirement accounts, in brokerage accounts, things like that. And so a lot of times you're looking at, okay, is it reasonable within that time period of the debt that you can expect a higher rate of return in those investments? The shorter the time horizon you're talking about, the more uncertainty you have there, especially if that interest rate is 6, 7, 8%, right? If you're talking somewhere around there, the longer you go, the longer your time horizon, thinking like a mortgage, like 20, 30 years, well, then you can look at the likelihood of those investments over that 20 or 30 years, whether they have a pretty good chance of outperforming or not that debt. That's essentially what you're looking at from a mathematical perspective.
Sure. Which presumably when we're talking about debt of a practice or debt of purchasing an office for the practice, that's where perhaps it does become, well, I don't know. Do you find it's a bit more mathematical than, say, someone early in their career that's kind of like, hey, student debt, I really don't want to carry that? Do you find perhaps the established doctor that's looking at taking on this debt truly looks at this as the investment that it is, looks at, hey, we're leveraging this because it's gonna deliver better than the next best alternative for our funds?
Yeah, I think it is. Especially earlier in your career with student loans, when you're looking at like what is the right repayment method to do, whether it's like paying it down to zero, going for long-term forgiveness, you're projecting out a pretty long portion of your life, sometimes 10, 20, and 30 years or 25 years to figure out like what could be the best direction to go. And there's already a lot of emotion and stress attached to those student loans, and cash flow is not as high as it could be later on in your career. So it kind of feels like the stakes are a little bit higher with student loans. The emotion can be a little bit higher with student loans. I think there's just more that goes into that.
Certainly. Yeah, absolutely.
When you're later in your career, your cash flow is a little bit better. You can feel like you have more options. Maybe you have more cash in your life, so you may have more liquidity in your life and in the practice. So in a lot of ways, when you're in that stage in your career, you can approach it more from an investment standpoint. Like you have a loan, you have capital, it has a certain cost. Here are your other opportunities with that cash. What makes the most sense? And sometimes even when it's mathematically fine to pay to invest instead of pay off the loans, you can still find enjoyment and getting relief from stress and just clearing up your balance sheet of paying that loan down. And oftentimes that's still the right decision for that person.
Sure. So on that note, as we're talking about this and kind of looking at this from a wealth perspective, let's go ahead and shift gears, because I know we were talking about some really cool concepts as far as for modern optometrists, no matter where they are in their career, how can someone grow wealth? And not only that, but really take a step further and how can someone measure their progress towards financial independence and financial health?
Yeah, I'm glad you brought that up, because it's easy to go to like, what are the accounts I can use? What are the tools I can use? What are the ways I can invest? But where I like to start is a lot of times we're investing for the future. Like we're investing a lot of times for a goal that's financial independence at some point down the road. And for a lot of us, we're 10, 20, 30 years away from that point in our life where we'd want to be financially independent. let alone the 20 and 30 years of our lives after that. So we're building wealth towards a time in our life where we really don't know what life really looks like. We don't know where we're living, where we're working, what we're spending money on, where grandchildren might be, right? So how do we measure progress towards financial independence in an uncertain future? And the way I like to look at it is I like to boil it down to actually one really simple benchmark metric. Like this is a vital sign of how close you are to financial independence. And it's just your net worth divided by your annual spending. So your net worth, which is your assets minus your debts, your net worth divided by your annual spending. And what that tells you is how many years of spending have you built up in your net worth. So for example, if you have a $500,000 net worth, just for math, easy math, you spend $50,000 a year, the score is 10, and that means you've built up 10 years of spending in your net worth. And when you really boil it down, financial independence comes from you have enough net worth to create income and pay for your living expenses, and you don't have to work, right? So you have enough stuff to pay for your living expenses. And so that metric is just one easy benchmark metric to sort of track over time. This is something I do for clients, and you can track that over time to say, okay, do I have enough years of net worth built up? Am I getting closer? Am I seeing that increase enough over my career? And what is like a target? It really depends for everybody, right? Like I maybe should have said this earlier. Like this is educational. This is not advice. So you can't take this specifically. Do your own due diligence, but that metric really depends on each individual person's situation, their time horizon, how long their retirement might be, what other income sources they have. But you can shoot for, just as a general target, somewhere between 20 and 30 years of spending built up in your net worth. All right. So that's a quick benchmark you can take, just your net worth divided by your current annual spending. And there's sort of a snapshot of where you're at, how close you are. And what I like about that too is that our lifestyle changes over time. Earlier in our careers, we're going to have one lifestyle, and as our income grows, or our lifestyle is going to increase and change over time. So that metric will also take that into account, because it's gonna take into account your current annual spending. So that's one easy metric to use just to see where you're at as a snapshot.
That's fascinating. That's fascinating. So then on that note, then it's as far as the vehicles. Yeah, I suppose then that's going to matter depending on what type of environment the doctor may be employed in, right? As far as what they have access to, private practice owners and what they can put away in different qualified accounts versus non-practice owners. So why don't you speak a little bit to that, and perhaps speak to it from the perspective of a practice owner and ways that they can grow wealth, but then also those that are not in practice ownership but are looking for ways to grow wealth.
Yeah, for those who are I guess I'll start with those who are not practice owners, because the lineup is a little bit more limited. So if you're not a practice owner and if you're employed somewhere, you're going to be basically limited to whatever retirement plan that employer has. So if it's an earlier practice, you might see a simple IRA plan. If you are in maybe a more established practice, you may see a 401k plan. So you have those your employer connected retirement accounts, and those employer connected retirement accounts are going to give you larger dollar amounts that you can put in as a maximum. So there's a maximum for each one.
Okay, yeah. So we're talking about growing wealth for the employed doctor, taking full advantage of the qualified plan with that employer is providing. Now, outside of that, what type of options, as far as the different IRA options and how to factor those into the planning?
Yeah, so you have a few different options. You have your IRAs, which are individual retirement accounts. They have a much smaller annual amount you can put into them. It's about $6,000, so you're looking at a much smaller amount. And you have a similar to the 401k, which I didn't mention about the 401k, but you have a traditional IRA, which holds pre-tax dollars. They're not taxed yet. When you withdraw from them later on in retirement, the amounts you take out are taxed then. So you have a traditional IRA, which holds pre-tax dollars, and then you have a Roth IRA, which holds after-tax dollars. And as the accounts grow, and assuming you follow the rules, when you are retired, you pull money out and it comes out tax-free. So you have two different options there from an individual retirement account standpoint. You also have the HSA, the health savings account. If you are employed somewhere, or if you're on a spouse's healthcare plan, and it's a high deductible health plan, meaning it has what they define as a high deductible and also a certain amount of out-of-pocket maximum. But if you're in one of those plans, you can contribute to a health savings account. And it has a pretty cool benefit in that the money you put into it, you get a tax deduction, similar to what you might see in a 401k. The money grows, you can actually invest it, and it can grow tax-free over time, meaning you're not paying taxes on any of that income. And then when you reach retirement, any amount you withdraw for qualified healthcare costs comes out tax-free. So you get three benefits in there. You can use it today or any time for healthcare expenses, but you can also choose to not use it, invest it, and allow it to grow, similar to a retirement account. And what's interesting is that you can actually save receipts from healthcare costs today, and then just allow that account to grow. And then at some future point, decades from now, you can pay off those current day healthcare costs.
Wow. Okay. Yeah. Fascinating. Okay. So we're talking about, again, we're talking about like tax preferred qualified dollars. We're talking about retirement. So we're talking 401k. We're talking IRAs. Hey, on the IRA front, I know we got traditional and Roth. I know a common question out there, can someone fund both the traditional and a Roth, or is it one or the other, a combination that adds up to a certain total, or what?
Yeah, well, essentially the total, you can do this in the 401k. So many 401ks have a traditional, like a pre-tax bucket, and also a Roth bucket. Not all of them do. The default is pre-tax, but many of them do have that Roth account too. Or you can have a traditional IRA and a Roth IRA. You can, the general rule is that you can fund both, but there's one max for both of them.
Gotcha. Okay.
Now there are income limits to that keep you from contributing to that traditional IRA and getting a deduction. And there's also income limits that keep you from depositing directly into a Roth IRA. But there are easy ways around that, perfectly legal, but just there are some income things to keep in mind. But it's the same thing with the 401ks, that you have a Roth, you can have a Roth account and a pre-tax account, but the total amount you put in as an employee is the aggregate for both of those.
Sure. So you mentioned income limits. What about those viewers out there that perhaps are high income earners that may be exceeding the income limits? What do they have access to?
Yeah, so let's think about that. The first thing you would take advantage of is your employer retirement account, right? If you're an employed OD and you're in the high income brackets, you're above some of these limits. Like, you're going to take advantage as much as you can of that employer account. For that Roth IRA, I mean, there's a method called the backdoor, which is essentially you put an amount into a pre-tax traditional IRA, but you don't get a deduction, and then you transfer it from that account over to the Roth IRA. That transfer is called a conversion, but it's basically just an extra step that you can take to get it to have the same end result. Put that amount into the Roth IRA.
Okay.
And then above and beyond that, once you start to get beyond your 401k, then beyond your Roth IRA, then beyond your HSA, there's always just taxable investment accounts that you can turn to. All right, so those are just regular investment accounts, not tied to retirement, but there's complete flexibility. So there's no rules in terms of how much you can put in, income limits, when or how you can take it out. You basically have complete flexibility there. The taxation is a little different, but you have total flexibility there.
Sure, and also not the limits. However, you're taxed on all short-term, long-term capital gains, and that's that's probably a whole other episode.
Yes,
other episode.
There's a whole slew of tax planning and investment stuff that comes along with that. But
absolutely.
But yeah.
Absolutely. And then also there's something to be said for just other investments as well, like real estate in other investment vehicles that would play into the planning. And I suppose the kind kind of pulling that piece together, it's a matter of really balancing where you are now and what your goals are, right?
Yeah.
And kind of plugging those pieces in that are most prudent to get you to those goals. So okay, so now let's talk about, we talked about growing that wealth for the employed doctor. What about that doctor that is in private practice? Let's talk a bit about the vehicles they have available to them to grow that long-term wealth.
Yeah, you have a lot more flexibility when you're a practice owner. Number one, you do have that simple IRA, but I'm just gonna skip over that because there's not a lot of flexibility that comes with that, and it just sort of is what it is. So I'm gonna skip over this simple IRA, and I'm gonna go directly to a 401k. As a practice owner, you can contribute as the employee, so up to the employee max. You can contribute a match to yourself as the employer, so you can add in an employer amount too. And then you can do profit sharing, which is you based on a certain calculation, you can add in an additional amount, and a lot of times it's going to skew more towards the owner just because of either age or income, as well as the employees. So you can add on an additional amount on top of that. So there's a lot more flexibility with how much you can add on as the employer, where if you're just employed, you don't really have discretion with that. It sort of is what it is. And so the maximum that you can actually put into the 401k, and there's a lot of other details here. This is the general gist, but is about 61,000. So as an employee, you're limited to 20,500. As an employer, you can stuff, assuming all the other variables work out, up to 61,000 into that. So you have a lot more that comes into that. The much more established practice owner, especially older practice owner with substantial cash flow, consistent cash flow, can do something called a cash balance plan, which is if you think about a pension, like this is a light version of a pension, but just the way that works, you can stuff in an incredible amount of money, hundreds of thousands, 100,000 plus into this account, if the math works out, and receive a tax deduction for those contributions. So that's another tool, when as practices get more established, especially as the age of the owner it gets a little bit higher. That's another tool at the disposal, so that over the years as you're contributing to your practice and reinvesting, if you feel like you're behind, well, there are tools for you to catch up using something like that.
Certainly. And yet at the same time, something you did point out, there are limits. I mean, there are rules and limits to these. I know there's different math that needs to work out to ensure that it's not top heavy, what have you. But on that note, I mean, should folks, I know another common question out there amongst practice owners that are, doing a big retirement program through the practice. Obviously, they're going to be required to involve their employees, and for that matter, it seems that everybody wants to involve their employees. It seems to me like there's this really great movement through the industry with doctors wanting to provide their staff with benefits, and it's remarkable to see. But that being said, common question is the fees associated with some of these, and what have you found? I know. Why don't you speak a little bit to that, as far as, should doctors be fearing the fees of these programs, or is it, hey, it's just a cost of doing business and roll with it?
No, I mean, for like early startup plans, there are providers, online providers that can provide startup plans for, I think I've seen like as low as a small startup fee, and then like $9 a month per employee. Like, it's even for startup plans, I would consider not even doing a simple IRA. Like, I would just at least look at both options for brand new plans.
Sure.
Even as you get more established, the benefit to you and to your employees, being able to invest for your own long-term financial independence, and the tax benefits that come with that, I think far outweigh the cost of what you're going to pay for these things.
Gotcha. So, private practice owners, you have access to these tools, and sounds familiar. There's also some really great options out there as far as kind of do-it-yourself things that are really inexpensive, right?
Yeah.
So okay, so then if we're talking about growing wealth for the practice owner, a lot of practice owners look to purchasing a piece of property for them to have their practice in. So how then does that kind of play into this equation? Again, financial planning, growing wealth for the practice owner.
Yeah, that's a fun sort of addition to the balance sheet is practice real estate. And the benefits there are obviously that you're going to have to pay rent to someone, right? So you can buy this asset. It's your asset. You'll get to enjoy the appreciation of that asset. And then you as a practice owner can pay rent to yourself. And so any tax benefits that come with that are yours. And if it's a large enough space, yes, there's a business reason for doing that in the practice. Maybe you need more space in the practice. You want to have more lanes, the optical to be larger, whatever it may be. But you really want to look at it in terms of like you're buying a real estate investment. So if you're able to have extra space to have other tenants, that's really where the return comes from an investment standpoint. What's interesting is that a lot of times, like you'll see practice owners own these properties, and then they'll retire and they'll exit their practice in some way, and they're the only tenants. So now's their opportunity to rent it out, and that's really where they're going to get the most of their return. Like the debt's paid off, they're now going to rent it out, have some income. And then a lot of the times, like they want to just simplify their life, so they end up selling the property and not enjoying that. But it's a really nice way to allow yourself to really, the practice owner, to pay himself the rents, get some depreciation benefits from that in the real estate, have an appreciating asset and an additional asset on the balance sheet, so that when you get to retirement, you can decide whether to keep it, rent it. You can decide to sell it, whatever you want to do. You have some optionality there.
Sure. Yes. And I think what's fascinating in all of this, and to kind of pull it all together, whether you're an employed doctor looking to grow your long-term wealth, whether you're in private practice looking to grow your long-term wealth, I think a couple of key things is to number one, really understand where your priorities are, right? I know it's something you said a couple of times, right? Like what do you truly value, right? It's not this, It's not money. It's more like, what can money afford us? What can wealth afford us, or our legacy, or our church, our community, what have you? But also something else you said that was key to this is measuring progress throughout the career, right?
Yeah.
Throughout the process, measuring that progress. So,
yeah, and there's, like you said, like almost again, like so many financial decisions are really like wrapped up in life decisions, and there's a lot of emotion and family history, especially, and values that come into that. And yes, there's math and there's those values, and you kind of have to figure out where on that spectrum makes sense for you. And again, you want to measure progress. You want to measure how close you're getting to those goals. You want to measure, what's the mix of your assets? Do you have appropriate liquidity, retirement accounts, real estate equity, business equity? Is there a good mix within those things? And are you using your cash flow effectively? Like, you want to be able to measure the progress of all these different things and to see where you're going.
Sure. Yeah. Excellent, man. Really, it's a whole fascinating world. The whole world of financial planning is fascinating. And, again, all these things considered, individuals and families and their priorities and goals. And certainly in this crazy financial environment and tax legal environment, it's a lot to navigate. So I suppose, Evon, to kind of pull it all together, and again, man, thank you so much for joining us, having this conversation. But to pull it all together, how can folks reach out to you, right, and learn more about kind of your scope? And if they have any further questions, how can they contact you to continue the conversation?
Yeah, you can send me an email, Evon, EVON, at optometrywealth.com. You can check out my website, www.optometrywealth.com. I have a podcast. Eric was a guest on the podcast, the Optometry Money Podcast. Check me out wherever you get your podcast, and I would love to chat.
Excellent. Well, Evon Mendrin, from all of us here at Akrinos and our viewers, thank you so much for joining us on Akrinos Access for this conversation around financial planning for modern ODs. On behalf of all of us here, Eric Matei signing off for Akrinos Access. Wherever you are and whatever you're up to, Go for it. Reach for the stars. And yes, there will be a recording here posted to Akrinos.com, posted to the Akrinos YouTube channel, and also it's going to be pushed out across our social channels. So
take care, everybody.
all right, Evon, thank you so much.
Thank you.